Good day, everybody. Brian here from quantlabsnet.com. What I'm about to show you is the results of a unique report I am been working on for the last couple of months. This is in regards to both futures and options at a very deep level. What I'm about to show you is just to focus more on the mechanics and the results of it. This will be going through quite a lot of iterations to get it to a point of where it's valuable and valid. Just wanted to show you the mechanics of it. A lot of the data uh, can be and probably is wrong. Also, the charting is built around that. And more importantly, because of the options and predictions that this thing tries to make, using options, not real world, in terms of the expensive data from option chains that I've gone over the last couple of weeks to months, which are very expensive. So it's simulated. What I'm about to show you again, the data is simulated for options, and the future price I can get access to. Now, this is specifically for options on futures, not options on stock or options on equities. So this is futures and options on futures only, commodities as a better statement. Anyway, so this is the gold futures. So let's go over through this and I'll explain each section. As you can see, it's a Word document, which will be eventually a PDF. But for now, anyways, as you can see here at the bottom, it's 40 pages. Okay, that's how involved this is. So the first one is the futures floor price. So it will try to calculate for if you were trying to do a combination of trades of both of futures and options. It can be done easily. A futures price or floor price is set at as a way to guarantee a baseline. So that would be your maximum loss or maximum you would exit at. And again, this is using gold prices from a couple of weeks ago. So this is around when gold was approaching around 3,000. So just so you know. Okay, so this is a lot of predictability here. So this is using something called a REMA. If you're into quant, you'll know what I'm meaning with a floor price. So this is trying to predict using that on a 5-day prediction, using this chart along with the different price lines up until I guess till beginning of May. And you can see here in red that will in hint at the potential direction over the next couple of days on the direction you can expect. Uh, if you've seen other types of reports, they'll put a longer red lines for predictability. I find from my experience, it's not the case. You have to just do it a couple of days at most, at best. And again, these are calculated estimates. Okay. So again, in red here, dotted, it is predicted. All right. So then we get into more quant stuff. When you start working with this, and this is institutional level sort of stuff, mainly for what the hedge funds would use, what a lot of the HFT shops would use. This is the whole purpose of this is to give you guidelines and when to stay in uh, your within your rail guards and what this will put out there as ways to make sure you can use for both uh, keeping all your trading and predictions and forecasting within those ranges and targets using both futures and options, mostly focusing more on options. So one of the things that we look at, quite simple math, is using cash returns, future returns, mean cash return, mean cash return, the variance of cash return, variance on future returns, and then we get into the standard deviation of cash return, standard deviation of futures return, among covariance between cash and future returns, and basically a correlation coefficient as well. Again, this is all calculated on historical data, and then we use that for predictability in terms of hedging and arbitraging, as you'll see later in this report. One of the more popular ways that this is using what they call Black-Scholes option pricing, the model, standard model. A lot of the firms will use their own modified version of this. They may even come up with their own, basically their own custom model or series of custom models that they use for similar sort of things. I put it on my blog various posts on that a lot of the very successful prop shops, a lot of successful the hedge funds, HFT, boutiques, all of them will use futures and options, namely in futures. If you look at a lot of the high paying jobs, they focus on these asset classes, namely mostly a lot with currencies and with the latest drop that we've seen with the unpredictability of the president of the United States. If you were watching what was moving in really extreme times, downtimes, was currencies. So that's why a lot of firms will focus on this, among other things. This is just one of many. I can track 40 U.S. specific future markets and so on and so forth. I'll explain what I'm doing later on if you are ready to commit to something that's going to be potentially big as part of the alpha and beta testing on these results to help validate these results. And there's really no cost to that, just based upon your level of participation and also your experience as well. So continuing along, as I said, we use the Black-Scholes option pricing. Here's what we call auto-loaded, preloaded based upon simulated data. You'll see what I mean later in this report. And also, once you figure out all the parameters that you're seeing here, you can also use that as a new way to gauge and then recalculate the Black-Scholes with better data, with better input parameters. So here, what we're talking about is call price, put price. Then we have our pricing parameters of being obviously our symbol. This case is GC, which is gold. We can set a call price, a put price, futures price, strike price, time to expiry, usually 3 months, and then risk-free rate. Many people will define what they think is risk-free. It could be 1 year out, it could be 10-year treasury, it could be a whole load of things. But again, part of my iteration on these reports is to set those standards. That's part of what I'm wanting to do with the validation, as I'll describe later on in this report, in this video. So here, one of the ways we're using Black-Scholes is to calculate implied volatility, meaning not current volatility, implied volatility in the future. We can also obviously calculate the current and historical volatility, but what's really more important is to calculate the implied volatility using Black-Scholes again. And in this case, we don't know. We assume we don't know. So therefore, we will simulate what we at best as we can to forecast. So in this case, you can see we have maybe a call implied volatility. We can use put implied volatility as well, calculating various symbols again, futures price, strike price, time to expiry, risk-free rate, and then setting potentially market call price and market price as well. Again, this is all options on the put and calls. So here, this is the really difficult part: is the option chain data. This is simulated. It's generated. And the reason for that is it's very expensive. I've shown videos and blog posts on it where it can cost anywhere from 2,000 to 4,000 a month, and that's for institutions. There's a commitment um, of a 1 year term, so you're already up to, let's say, 48,000 US a month, a year. Plus, you have to pay licensing fees as well, and it can be more than $50,000 a year. So if you get access to the data, you're in a different league, and it's closely guarded. Like we can get option chain data for equities, but not futures. And they do this on purpose with the CME, the ICE. They do this on purpose because they want to keep us equivalent peasants out, the retail trade crowd out. This is the type of data they use to help them through their lobbyists to make sure that this is specialized set of data that we do not have easy access to. So as best as I can, what we do is we try to generate this option chain data. And again, it's simulated. It's not real. It's simulated. All right. So we can set a step size, and then we can potentially set a calculated guesstimate on the strike above price and the strike price below. We could set maybe an expiry date as well. There's many ways to attack this. If you are on Interactive Brokers, you can get kind of access to the chain data. but it's very difficult to automate it. Get access. You don't get access to it via an API. You can visually eyeball it through your through the software of Trader Workstation or TWS. But again, to automate that kind of works. But the chain, if you've seen the tables on the put and call bid, it moves very quickly, so it can change very quickly. And the only other way to get around this is by doing crazy simulation, and obviously having access to a stack of GPUs as well. So here, what we're trying to figure out is our call status, if it's in the money, or on the put status, which is out of the money. And then we can calculate our moneyness potential out of that, along with the various strike prices. Always remember that strike prices are always set by the exchanges. So here, this is what we're doing here. It's just a simple strike price. What are different call statuses or put statuses, and what are the moneyness that comes out of that? Okay, so then we can also get into the more minutia of it all and look at the actual detailed option chain from that. So in this case, we'll have one side which would be your calls, the other side based upon the price as well, or really on the strike price right here. And then we also have your puts and calls. Okay. So in here, you can quickly use the Greek analysis, which is used pretty well in quant finance, the rho, theta, vega, gamma, delta as well. And then we can do the same thing and do that for every chain, every strike, and simulate it as best as we can. But this is very difficult to build, but I've managed to do that through the magic of artificial intelligence. Without that, a lot of this wouldn't be available. With the artificial intelligence, you'll see how more intelligent it goes in terms of what you see in the results. It gets more and more intelligent as time progresses. This has been worked on over the last few months, and with the recent um, releases of things like uh, the DeepSeek and whatnot, that analysis can get more intelligent as well, and you'll see the results of it as well. So as you break through this, we can then look at using Greek calculations to get better gauge of the what's happening in the bid and ask or the option chain data. So here, a lot of people will focus on delta and vega, as you'll see what I mean as we move into it. So here, in some of the reports, I can give definitions and impacts as well. So here, delta measuring the change in option price for $1 and change in the underlying asset price. So that's going to be your future contract as well. Put option could be a positive delta, or put negative delta as well, with a range between 0 to 1, -1 to 0. And that's what you'll see here in each of these in the chain as well. But it's very hard to gauge from that. There's one way to do it. So there's different firms will do different things with this type of data. They'll, as I said, they'll have their own custom models as well and calculations. So that's where they get deep into the quant stuff as well. Um, so we got the definitions out of the way. Um, so here we have in our Greeks, we have the delta, gamma, theta, and vega, and go further as well. So again, coming back to this as well as I already defined what the delta can be. We also have three more, the gamma, measuring the rate of change of the delta. So you can see how deep you can go on a second derivative, I guess you could call it. There's theta, which is the time decay of an option value, typically negative, and also the vega, measuring the sensitivity of the option price to a 1% change of the implied volatility. A lot of people won't pay attention to this, but once you go deep into the analysis of this, this can help you down the line to predict where things are going in terms of the options, and you can make very good calls with that. Sort of that, a lot of things that goes more fundamental that people will not pay any attention to is the call put parity. That's kind of like an equilibrium in the price as well. So here we can do a call put parity calculation using these formulas where we can calculate will the parity hold. Now, if the parity holds, and there's a chart here, remember I'm using wrong data here. But the point is here, this is where the opportunity comes up for high frequency trading operations. Once they see this, and this is why it has to be low latency or ultra low latency, is they're looking for exactly this. If the parity will hold between the call and the put, okay, and if the parity does not hold, that signals now a opportunity that can last only a few seconds. So if you're a market maker, you can flood and provide that liquidity into the market and take advantage of that through a variety of trades. So here's that quick call parity. Usually here in blue on the call, and the put uh, will usually be equal, as I said, because there's an equilibrium. Because on that price, and if that equilibrium gets blown out, even for a small amount, that's a trading opportunity for those that are operating at a very quick level and watching this type of data. Okay, so another thing that they look for is the risk return. Now, we're not doing what the retail traders do, what we can classify as uh, the not smart money. Okay, I don't want to be insulting here, but this is what the professionals, this is what the institutions do. So if you want to succeed in the world of trading, this is the way you want to do it, to be able to look at this and analyze this and understand the different tools and different types of analytical data that you have available to you, um, and be able to analyze this. So one of the other things they look at is a return. Uh, Again, forward looking. Most of the institutional traders will only use forward looking data. They will also use fundamental data. Once we get to the technical analysis part, I'll explain the technical analysis versus what I'm showing you here. What I'm showing you here is about 95% of what is used in forecasting and what is used for predictability the smart way. And again, then there's a second, third derivative of all these quantitative techniques to be able to build out their own proprietary models and ways to trade. And that's what I'm speaking about from the quant shops, the hedge fund shops, the HFT shops, because this is the sort of data they look at as examples. So again, as I mentioned before, we're looking at the hedge math before and using that type of data to be able to build out these kind of forecasts as well. So we have a risk using our standard deviation with an expected return. Obviously, you want to be able to mimic the optimal return. So we can have our indifference curves here set by this U value. And at the same time, we want to find what would be our optimal portfolio be set at. So one of the other things that they use, and I've shown this before, and I put about 5, 10 videos when I worked on this. One of the big things that a lot of the firms will use are payoff diagrams for different strategies that are available. So in this case, they're looking at dynamic. These are dynamically generated, so they're not real, and they're again, it's using simulated data. Here, if we set an expiration date on May, so if today is April 9th, I'm able to calculate when contracts are available. So that's real. And then we'll use those various contracts and be able to measure out the appropriate call, put, and all that, and generate what you're about to see here. So the call premium, the premium can be set. What will potentially the maximum return price be? uh, and our lower and higher premium. We can also guess well, I shouldn't guess, but quantitatively figure out what the lower strike and higher strike should be, our premium, our strike price as well, and our put. Okay. And then how many strikes are we using? This one's using 5. If you got better hardware, you can set this up as many strikes as you want or what's available, and then being able to run again simulations, which they do through the equivalent of Monte Carlo simulation, running all these kind of analytical data and being able to choose their optimal uh, portfolio position right here. Okay, and that's what it's about. You'll see what we call H star or the optimal hedge ratio. So again, long call option payoff diagram. Now, some of these are going to be really messed up based upon the simulated data is really out of whack, or the data that I purposely put in here between the cash price and the futures price on gold. I purposely did that. So you understand what's available to look at, understand visually what's there. This is not real, but I purposely made this incorrect. One of the things I want to know, if you really want to get serious about this, behind my membership or my paywall, I should say, I do have that course. If you don't understand what I'm talking about, it's very intense, 5 to 6 weeks. I mean, we're only at page 8 out of 40, and you can see how intensive this type of analysis is. But this is what the professional traders do. This is what the professional shops do. And that's why they pay the kind of money they do, into the millions of dollars, if you can consistently profit from this and make calls and you scale up your positions and portfolios based upon the results of your trading and your performance or overall performance. So then here, if we look at our long call option here, we have here different payoff. We have our strike price and max loss. The thing here on the max loss, you have to understand a lot of these trades can be what they call riskless, meaning the most you'll lose is on your future contract versus your option and set of options as well. Here we can dynamically set how many option strikes do we need, how many future contracts do we need as well. It's all dynamically allocated based around simulations and what data is available. As I said before, if I was able to get true option chain data, this would be a lot more valuable as well for these type of analysis as well. So here you can see with the payouts, we can have a bull call spread, we can have a long call option, and these are all with the different payoffs, all the different metrics of what the strike or the profit loss will be. Okay, and then it calculates your break even here, which is the red as well, and here as well. So you're able to calculate your break even, and then from that you'll be able to optimally set what parameters you need to get an optimal trade in the normal world, minus what we're going through now with exogenous forces that come into play when you're dealing with somebody who's an erratic president making all these calls and guesses that can greatly impact your trading performance and forecasting. So this is the safer way to do it, is what I'm saying. That's more effective, even though you can't guarantee yourself and you don't what I'm saying is you don't have guarantees in this world that we're in right now with the crazy volatility, all of the whim of a president that can heavily impact things and the responses from other countries on this tariff trade and whatnot. This is helpful. This is like a better insurance policy that's available to you. So again, here we can have a bull call spread payoff as well, a bull put as well, and hopefully you can understand and uh, be able to understand this and decipher it, um, and all that. So what you're seeing here are different types of option strategies you could use. As I said, some of them could be bullish, some of them could be bearish, as you're about to see here, and some of these are this is what we call the for types of strategies available, like straddles, iron condors. This is what you're seeing here now. So a lot of these strategies can be messed up because I'm including everything possible. So the ones that look realistic, like this one, maybe a wise strategy you go with. That's an option to lay out your option trade as you lay out the position of the option trade, the parameters that you're expecting, setting your targets, along with any potential future um, position as well, or future contract, the amount of future contracts as well. You can see here. So now you have a neutral strategy. You also have all the different types of strategies. It's iron condor, all of those. That's what you're looking at in this section here. That's how powerful this section is. I just don't specifically label those strategies in these payoff diagrams, but I could easily do that and will, obviously. So here, we're now moving into more complicated things like a calculated iron condor. As an example, we have our put strike, um, 1, 2, call strike. And again, this is simulated as if you were to play with potential strike prices and scenario and play out all the different scenarios as well. So here we can set current premium, current strike of a call, and see where things are going. We can build out a strategy from that using the iron condor payoff, using the different combination of uh, strike prices and call strike prices as well. Here we're using iron butterfly variables. So here, if we set a middle strike, middle premium, one and two as well, and you can see all the different things. So here we can see the iron butterfly payoff, put strike, middle strike, and call strike as well. And again, that can be a whole combination of what they call a synthetic option as well. And that's basically a couple of options that you create synthetically and combine with maybe a futures as well. Here we have hedging strategies as well. And again, a lot of what we're talking about for a lot of the firms use is hedging and arbitrage. So you'll see more arbitrage as well. But these are some of the available hedging strategies as well. So here we can get cover call payoff, strike price, a strike cost as well. The same thing here. This is protective put as well. So we have a protective put. So if we expect we want to do a trade, and it doesn't matter if you're going to write an option or buy an option as well, or sell an option. You could go both ways. Most people that are professionals will want to write an option because they get an income from the paid out premium in the hope that you don't profit. Because if you don't profit, they get the income from that on that option that you're ready to buy on the speculating side. So again, we include all this. Again, covered call. We've got here protective put, a caller payoff as well. And you can see all of the different things that you can measure here: caller payoff, strike price, call strike, and stock cost. Okay. And then it gets even more. This is where the value comes in because this is what the professionals use. This is what the professionals look at. And again, this is the sort of thing you can learn through my course that I've already mentioned. It's 5 to 6 weeks uh, for obvious reasons because this is very complicated. And yet, just looking at that, we're only on page 10 of 40. So this is where it can get very complicated very quickly. So here again, we get another payoff analyzer. So in this case, we have a future versus a call option pay diagram. We have a future payoff or a call option payoff. So which one would you pick on the call versus the future with that? And this is again the results of generating some pretty nicely detailed uh, payoff diagrams. You will not get this. You will not find these strike price break evens in a lot of software, especially in TWS, because I looked. Your brokers won't give this to you either. They'll just give you a bunch of lines, but they don't give you what you should set as your target. Here you can see it based upon on what it thinks is optimal. So here we get into a futures versus a call option payoff diagram. Okay. So again, future payoff call option as well. Then we get put option payoff analyzer as well. So we can set entry price, strike price, and put premium. Same thing right here. This is where it gets really wonky. Anyways, uh, but this, I think this is the last of it. So we can get cash put payoff as well. Um, and yeah, long cash position versus a put option payoff. So all these different combinations we can kind of see. Some of them, as I said, are wonky because they're just not doable based upon the data that I give each plot, right? So again, I've talked about arbitrage. This is where it goes deep on the arbitrage. So here we can look at the arbitrage position. We can calculate what our profit loss would be at expiry, uh, assuming that the future price does not change. That's a perfect world, obviously. So here we can figure out a future P&L, a short call P&L, long put P&L, and then the overall net loss or net gain on that P&L. So here we can get arbitrage opportunity analysis again. So current price set at 29.10, future contract price at 2019, and then depending upon who's looking at this, because we have to factor in institutions do these type of trades as well. So they'll have things like storage costs as well. So we need to calculate that as well if needed. But just that's why there's a storage cost. Another thing that people don't figure out is there's something, and that's what you learn in the course, is the opportunity course. Opportunity cost. So you may want to only trade certain things, but there may be an opportunity cost that where you could trade something else that will give you a profit, and that becomes now an opportunity cost that you've missed out on, and that would be a cost to you because you missed out on that potential profit. Okay, so again, we can now start developing different strategies based upon what I'm showing you here. So we could have a buy commodity at current cash price. We could sell future contract at a future price, or we could store the commodity until further futures expiration. So there's different options that producers could have. So here we can calculate our potential profit based upon that arbitrage, and then we can get a conclusion based around that if there's an opportunity for arbitrage exists and if it's profitable. That's a nice thing right here. People like to see that. And that's again simulating, forecasting, simulating. And that should raise your confidence in your trading. And this is very, very helpful, very, very useful. And this is why it's done, is to get a better gauge on profit potential, what to avoid instead of just using your gut, your hunch, what cousin Johnny told you. That's not the way to trade. This is what professional traders do. This is what the smart money does as well. Okay. And that's why people use options and futures, because they have the availability to use this type of data to help them to quantitatively predict what will happen. And then they set targets and be able to say, yes, there is an opportunity there. Therefore, I'll make that trade. Here are my targets. Here are my entry points, instead of just using simple things like just hunches off of charts or what they see on CNBC. To me, just the dumbest way to trade. Anyways, continuing along. So again, if we do an arbitrage opportunity hedge with hedging, it gets more complicated, obviously, for gold. If we have a cash market price per unit, because that's important to know as well, because this could be used with treasury, but that's with $1 million. That's a whole nother world. We can do the same thing with yen in the futures market. That's another whole nother world. So there's different measurements for different units of cost, and no different than what you can find in call it SOPs, lumber, cattle, agriculture products. So if there's crashes right now, there's still places you could trade to make a 10, 20% profit and get those returns, knowing about them in other uncorrelated assets and asset classes. Again, let me say that again, uncorrelated, because that's what professionals want to hear. It's uncorrelated, meaning it's not correlated to something else. So as an example, Bitcoin. If it's correlated to the performance of the NASDAQ, or Bitcoin's correlated to the performance of the US dollar, people don't want that. They want uncorrelated. This also includes gold as well, as an example. Gold is not proper because that can be manipulated, because it can be, even though it's technically quote unquote uncorrelated, it's still correlated, but it just does the flip side of what you expect. So if you expect the stock markets to go down, people pile into gold because it's uncertainty. There's manipulation that goes on there that I could talk about, but I'm not going to put that and make it publicly known, due to, call it censorship, call it to whatever you want to call it. But there is definitely manipulation from the big boy, the big multi-trillionaire, trillion operations like BlackRock and Vanguard. They're the ones that can do all kinds of manipulation without you knowing it, and you'll never see that in the public domain as well. So that's one of the other things that down the road will bring value as well, because, and no AI, let's face it, no AI can replace that either. No artificial intelligence can replace that type of knowledge on what the insiders do, but other people will know that and know how to navigate to avoid those kind of risks, because they are very dangerous and you can lose a lot of money. And I fear a lot of people will lose a lot of money, and it's already been proven, because of the extreme down moves that we've seen over the last few days, all because of a president who decides at whim, decides to take, let's say, the U.S. to a radically different direction based upon policies and dare I say, an ego, which you know what I'm talking about, anyways. So again, arbitrage opportunity, again, doing arbitrage hedging analysis. So if we have a cash market price at that 29.10, future market price at 29.18, and then there's another big thing here is the cash position size, number of contracts that you want. You need to know the potential contract you want, unit contract, which is important to know. And just so you know, that this will go through another iteration again. This is just the data I'm using, but my source of data will need to change as well to make it more accurate. Because again, this is, as I said, this is either simulated or purposely wrong for what I'm showing you here. Anyway, so here we can go through all the different calculations on the arbitrage for this, where we have cash outlay of X. We can generate future revenue of X. We need to know the number of contracts needed for the optimal arbitrage, and what would the eventual converge price be needed to achieve that profit that we want. And again, these are just a number of parameters that you need to know to calculate that. And what if we don't achieve it? And to know the break even, to know the targets as well, when to get in and out. So here, when we do these kind of simulations, we can calculate our potential profit, and then from the simulation, we can ask ourselves, is there a profitable arbitrage opportunity at these parameters, at these prices, these values? In this case, no. Just as an example. So again, here we have an arbitrage portfolio analysis. So depending on how you set your portfolios, some people will just use one big portfolio. Some people will have portfolios based upon asset classes, all kinds of ways to define a portfolio. But some people will have sub portfolios. So we can use that type of smaller portfolio analysis to be able to gauge what is needed for potential profit. Again, as an example, current future price at X, we need our strike price at X. What's our premium that we could receive so we could get a loss, or maybe a put, and what's the contract size that we need? Everything, because this is gold, I'm just assuming one unit, right? One bar of that price. But here we can go through the profit loss scenario, the P&L. So here we can have our static, no price change at $300 per contract. The P&L, if the price rises to 3,200, we'll lose this. If the price falls to this, we'll gain that. So you can hopefully see, and as I said, have a much better appreciation for this type of analysis and predictability and forecasting. So again, we do another example. It's all about role playing and simulating and knowing what to use. Again, this is all using AI, and it gets much more sophisticated. Just so you know, we're only halfway through this. Okay. And then again, arbitrage position analysis. So what do we need to set at if we have a P&L at expiration, where a future P&L could be this, a short call P&L could be that, a long P&L could be this. And again, we just role play. That's all we're doing here. So analysis on different scenarios. We have a call put premium difference of this, future strike price difference of that. And here is where we can gauge the observation. Does the arbitrage opportunity exist? Yes. And what's the combination that we need to achieve this arbitrage? We need to do a buy, a call, a put, and sell a future. So you can see what's happening here. We're using this as basically as a framework, using this data and being able to generate uh, strategies from this. Now, again, this is a framework, so you have to be able to quickly come up with a pricing engine to be able to fulfill this strategy. From the coding perspective, with the help of AI, that can be done fairly quickly, knowing what you want, knowing what your targets are. And with AI, you can generate your code, your source code, actually, to work with, let's say, most cases for people with a interactive brokers API, be able to plug that in with the generated code. And as you move farther along with your AI of choice or your LLM of choice, it'll have that history from the chats that you do with it, being able to generate better code with better results, knowing what exact strategy you want. That's key here, moving forward instead of working in a static mindset with no real dynamic frameworks. If you understand what I'm saying, if you got questions, let me know. I'll only answer them on my forum and privately as well. So again, because knowing this sort of thing, the point here is that we're able to generate a strategy. How many calls do we need? How many sells do we puts do we need? And do we short a future or a long a futures contract as well to be able to build out this optimal strategy? If you can see the goal here. So again, we have an arbitrage position analysis, setting a future strike price, shorting call premium, long put premium with the short call premium as well, and being able to find out what our optimal contract size would be. And again, we'll figure out what our P&L will be in a static scenario. Again, with futures, no price change, and what would our short call be, P&L along with a long put as well. And then again, we get an overall P&L as well for all the arbitrage strategies you want to use as well. This is the nice thing I like about this type of analysis as well, is that you can see, which a lot of platforms give, but again, they don't give you what would your minimum premium need to be on the put, and same with what would your need be on the call minimum, and what would you set your maximum at as well to profit along this payoff diagram, measuring once again your optimum option premium along with the future price. And again, you can see here that it would also include the price call pricing as well. And this is the ultimate what people want right here is the gold area zone. So you want to be in this orange, setting your boundaries on your put max, your put min, uh, and then your put option area. This is where you want to be. Also on the call min and max as well. Here, the idea here is to set your minimum on, if you do, let's say, a futures contract, to set your minimum loss along with the arbitrage and hedging combination. If you get it right, and as long as things play in your favor and move in your direction, this can be unlimited. So, I'm not a big fan of uh, of a leverage, but if you get comfortable with this and it works for you, and you're in a fairly stable market conditions and market regime, then yeah, leverage can work in your favor, especially if you see put options with unlimited limits. Okay. So, and that's how people's lives have changed via options trading. Okay. So again, here's futures options report. Here we're looking at the hedge effectiveness analysis. So this is a measure of recent prices in both cash and future markets against 5 days ago. So this is using historical data instead of forecasting. You can probably accurately forecast data with the true options call data. Okay. And again, I've already mentioned the prices. Very expensive. Okay. So we have initial cash price, initial futures price, initial basis. When you hear basis on your CNBC or your Bloomberg, this is what they're talking about. Okay. Very important to know there's things called basis risk. And that's what we're kind of going into know. So if you're a retail trader not knowing this and you continue to trade uh, blindly, I guess you could call it, in the world of ETF or basically equity stock ETF, you'll get killed here. You will get killed. This is how you lose money and how you give back all your profit, because you're not intelligent enough to see how this plays out. So you need to know the risks from the institutional level so you know what's going on. So here we set our initial, and then we may have to calculate our final future and cash price. And then from there, we can calculate our final basis as well. And we can also role play if that basis widens against us. So if we're doing the hedging, which again, a lot of firms use, will it worsen or will it improve? Okay, based upon these scenarios. So again, we can use things like a hedge ratio calculator, knowing that these are reports in there that's going to kind of come out daily that I can do. And then here in this case, what's the cash position size we need for optimal hedging? What's the future contract size we should hold as well? So here, as I said, we can figure out what would our exact number of contracts needed. Um, and if we need to round it up, it depends. Like This information would be used for contract sizes going into the millions. So you could see 20, 50 contracts for a futures position along with your options as well. So here again, with the hedge fund scenario analysis, if we have a current today cash price, futures price, what's our basis? What happens if we widen the price or expected widened price? What will our basis risk be? Okay. So here we can see the financial impact based upon those forecasts. We can see if we get a cash position loss on the number of units and the contracts we have, along with the position gain as well. And then we measure what's the net outcome. So in this case, the hedge effective could be effective and the hedge was overhedged. And again, AI will give you different results within the report based upon these conditions. Knowing this stuff, predicting is one thing, but again, to be able to use real option chain data is very, very helpful. So this is what I'm talking about here on the hedge math. This is we'll call it the first step, the first gateway into using quantitative methodologies. Figure out what would our optimal hedging need to be for position value on cash, on futures positions. What would our expected be return for the cash return and futures return? You can see here, if this was a formula, you would get the symbol names along with the risk parameters of the variance as well, and the covariance and the hedge results as well. This is what you want. That's how you set your optimal hedge ratio and knowing what it needs to be. Therefore, if you know your optimal hedge, what would your optimal futures value need to be? And as well, if you're doing this against an entire portfolio, how much are you willing to hedge on this particular set of positions against the whole portfolio and the risk and return that comes with that? So this again, you're quantitatively, qualitatively measuring on how much you should allocate capital based upon this analysis. Okay. So again, we can figure out our hedge portfolio variance along with our variance reduction. So again, moving different scenarios again, hedge ratio calculations, how many cash position units would we need? It could be barrels, it could be whatever you're trading. What would the futures contract size need to be? What's our exact hedge ratio? And we can play around with this. So in our case, we'd need one contract needed, 100% coverage on the position against the whole portfolio if we feel really strongly about it. And again, what would the impact be on that impact ratio on the potential profitability if we did multiple number of contracts to hedge with the 100% position? So in this case, we'd say, yeah, maybe more contracts would be needed. Therefore, you may get better protection but higher cost and limit upside. Or do we take fewer contracts to lower the cost but get less protection if the price drops? So these are the numerous considerations. And you can do that through simulation as well. You need the right data and know what to predict. So here we need to understand the basis risk right now, being on April 9th. This is what HFT firms are doing. This is what the hedge funds are doing. And this is what the governments are doing. And this is exactly what banks are doing to calculate their basis risk when they put on things when you see exploding bond risks as well, meaning people are buying up, let's say, U.S. Treasury for debt to finance the government, and they have a spike in bond returns. They're going to want more risk reward or more reward for the risks they're taking, and as a result, that will greatly impact Treasury space. So this can be the area from an institutional level where things can blow up, not just blow up, but blow up the entire financial system, along with huge economic costs to not just governments and companies and people as well. This is so important to know. So what could they do? You can narrow the basis. So if you let's say have a narrowing basis, it's good for shorting hedges. And again, knowing this, you can trade with that, knowing the conditions, and maybe do the same thing. You can profit off a loss as well. But if Mr. President comes along and says something and it goes against you, you could lose big here as well. So you have to be very careful. But the tools are here if you wanted to try it out. I wouldn't do it, but it's there. So if we expect a narrowing basis we have where we have a positive for short hedging, futures go down more than cash price goes down, hedge becomes more valuable. We have a widening basis, meaning negative for short hedges. Cash price goes down more than the future prices go down. Hedge provides less protection. So here's what we always want, the optimal. What's the perfect hedge? Well, we want the basis to remain constant. Good luck with current conditions right now. And the price risk has to be fully eliminated. When you're dealing with the kind of president we got right now, um, this is where it becomes price risk is not is risky. It's not stable. So it's not the perfect scenarios to trade it. When in the case of the U.S., when their national debt goes up, Treasury becomes a problem, and it becomes riskier as well. Those are the things that we face today. I don't know when you watch the video, but again, April 9th, 2025, when this was recorded. So who knows where it'll go. Hedging strategy scenario. So again, how can we hedge, let's say, a gold purchase? And again, this is not real data. Okay, so don't depend on this. Is not investment advice, just so you know. You are obligated to purchase a gold contract at this rate per bar. Ooh. With the risk, market price rises above that, you face potential losses. If the price falls, you could still pay out uh, that amount. And then what's going to happen? Again, this is the AI kind of pre-programmed in each section, very simply, very basic, but that's how advanced it's come along now. In this case, with the hedging, might be wise to lock in a price. So again, we can generate different strategies from this again, and then maybe we could sell a gold GC next futures, create a short position, offsetting your long position. And this is how you can build out a strategy combination to minimize your risk. And in fact, hopefully, in a smart way, be able to eliminate that risk and only uh, be able to profit from it based upon what you're seeing here. Again, it's not investment advice, but just to give you, these are guides to help you build out uh, uh, your forecasting on what you should or shouldn't do, or at least things that you should consider. So if you have a price decline, you have a loss on the cash offset by the futures profit. So again, this is when you combine options and futures together to eliminate or reduce your risk on these type of trades. Not a lot of people will be willing to do this, but this is what the institutions are doing. If it goes wrong, goes bad, then well, then it's a big problem because you take on losses. So if the price increases, your futures lose, but it's offset by higher commodity value. Key takeaway again, this is where the AI can help as a suggestion. And again, it can be dynamically generated as a framework to work from. If you futures hedging locks in a purchase price. So if we set options hedging, setting a maximum price here, this strategy, buy a call option on a gold call option. Let's say you have a strike price of this with a premium of that, with the P&L against to know that we need to calculate this. But this type of data I'm not going to obviously provide for free. It's going to be behind a paywall. Once it gets working, then the value of it goes up. You can see that. So if the price rises above the strike, your options gain value. If the price falls, your option expires worthless and you lose. Your loss is limited to the actual premium that you pay out on that option. So you have a key takeaway here with options hedging sets a maximum purchase price. So sometimes you want to know how to compare the two, the hedging with futures versus options. So here we can know if we're doing a futures hedging, call options. Here's supposed to be a table, but this thing needs a lot of improving. But just to give you an idea how this will eventually work. So if we're using something for price protection, We want to use the future hedge to lock in a price completely. With the call option hedging, we can set a maximum price. With the upside potential, if we do futures hedging, it's eliminated. Call options preserved after we hit our premium, but their downside risk with the futures hedging is eliminated, which is kind of what you want. Here on the option side is that you will pay out uh, what you pay out in your premium on the options. For here, your cost will be lowering your futures hedging, and all you're paying out on your option is the premium paid. Okay, that's why a lot of people prefer to trade options, and you can do again the combination purely with options. The only thing you're going to risk losing at the most is the premium you pay out. So, with flexibility, you have a binding obligation, meaning if you just trade futures and something goes bad, you'll get a margin call from your broker. Um, so that's part of the course that you learn these sort of things. It's just a high level snapshot. And again, with the options, you have a right, but there's no obligation where you can get in or out with the options. So the margin requirement's higher with futures and it's lower with call options. And again, as you build out a higher account size, you can do both, combine it, as I've shown earlier. So again, here we look at all the different hedging math, and then we can, from all this fun stuff, with the standard deviation on cash, standard deviation on futures, we're able to calculate our hedge ratio, and we can get that from the covariance as well, or the correlation. So here we're able to measure out potential portfolio returns as well, the covariance on the hedge and the covariance on the correlation of the hedge as well. So again, covariance on the hedge and correlation on the hedge as well. And again, what most professionals right now in the extreme market conditions were, they're looking for a zero uncorrelated markets out there. And yeah, they exist. They're not have anything to do with crypto, have nothing to do with gold, have nothing to do with energy, and have nothing to do with treasury or financial, and have nothing to do with stocks as well or equity. So here we could analyze our hedge portfolio. Uh, we can see what our hedge ratio is if we set it, let's say, at like at 50%. We can measure out our potential return on the portfolio. And again, that's with the current here. But if we did the optimal, um, knowing what we know, we can boost our portfolio return quite a bit. So almost doubling, not quite doubling it, but more than 50% higher doing this sort of thing. Um, and again, here, when you look at the variance, the whole idea is to reduce that variance to reduce the risk. Again, there's also, I mean, I know this is a lot, but this is why my course is 5-6 weeks to understand this, to know and live and breathe this stuff. Because on the downside, you can do pretty good. On the upside, when the markets have a high momentum, you can take that, what most people get, and magnify it quite a bit. Variance reduction potential. Um, Here, we're looking at hedging the prices with the put options. What would our initial cash price be? And this is again on the futures price or put option as well, cost per bar in gold, let's say, or whatever the unit is. Option premium would be this. And again, using AI, again, what I've built out right now is very basic, but the advice would be long cash position, profit increases as price rise. Put option provides protection when the prices fall, is what you want, as I've said before. And sometimes you might want to combine it, which is a lot of the time you will. You want to limit your downside while allowing your upside potential as well. Okay. And again, you should be able to see this in a proper plot, but well, we've already covered the data as is. So here we can do a call option, and it's now because I'm not able to use real world option chain data. It's all kind of either historical or forecasted and simulated into the future. So a lot of this is wonky. Try to do our best to work with what we got, but once you get, as I said, real world option chain data for futures, these reports would be a lot better, higher quality, more valuable as well. So again, we'll call option week one. What this is using this type of a call. Future price could be this, strike price could be that, total premium as well. This is another thing people need to understand. What's their time value going to be? Which is really your delta. Got that right? And the one thing that needs to be calculated, a lot of people will not calculate it at all, is your intrinsic value. So that's your value if you were to trade this and it's open, but yet it's not closed off. So intrinsic value is where it's at in the future. Okay. And the way things are going, they want to now tax intrinsic value on things. It's crazy what these governments are wanting to tax. So again, if we have a call 1 week ago, analysis again ago, meaning prior 1 week. If we have a call option, I think, yeah, so these are call options. Future price, strike price, premium, intrinsic value, time value. Then again, we have our put option call as well. Same thing, same parameters, futures price, strike price, total premium, intrinsic value. Now we're starting to see the intrinsic value. So we know, do we do a put or do we do a call? And our time value will be this. So using time value analysis, option premium set at this, intrinsic value be zero, time value be set at that. So using AI, you can kind of get deeper as this becomes more intelligent. You can put better AI generated results into it. So here, time value represents a portion of the option premium, not attributed to the intrinsic value. Again, on the terminology, I got a whole course on this. Okay, so if you want to know about it, just ask away in comments or whatever, and I can lead you to where you need to go. So knowing the time value, it reflects the possibility of an option becoming more profitable before expiration due to price fluctuation in the underlying contract. Okay, so there's factors which affect your time value, timed expiration, and the volatility of the underlying contract. That's why when you're using something like Black-Scholes, that implied volatility, it's so important to know and be able to calculate correctly. When you're simulating it, it's not the best. Or I should say, if you're simulating it off of simulated option chain data, that's not going to help you. But if you're able to simulate and forecast off of provided from an exchange on option chain data on what institutions are buying and setting up through their options, you can get a much better call on what the implied volatility will actually be using the Black-Scholes. Okay, so here we can set up our options detail. Again, what would our strike price be, current price, what would the premium need to be, and what should we do using, in this case, time to expire in 90 days. And it gets more valuable as your expiry starts to close down. If you watch the fine folks over at Tasty Trade, they'll tell you 3, 4 days it's approaching, and actually, no, I should briefly. It's higher. Your profit potential is higher on the longer options out there because it's more risky. As it gets closer to expiry, then your option potential and profit potential goes down as well. So again, needing to understand the intrinsic value, figure out your time value, and your daily time decay, also known as your theta. Here we can have different scenarios that we can use on a 30-day call option. Again, 30-day call option, all the same simulated data as well, intrinsic value. So again, here, knowing all this stuff is very important. So now let's talk about technical analysis. Technical analysis is good for when you are about to time something. You know what you want to trade, but you want to trade when to enter and when to exit. And that's all you need to know about technical analysis. Everything else you can see is using all the standard principles for futures and options, knowing what strategies to use and what combinations, where most of the time will be spent, and along with your simulating and forecasting from that. But here, it's helpful to know two technical indicators. First one is the simple moving average. So in this case, you can see on the closing price, what pretty well works and most reliable are your crosses. Okay. So if you know on your closing price in your 5 day, 20 day, or 20, 50, or 100, those are very reliable. That's all you really need. Okay. So this is just for demonstration purposes. The other one is a form of an oscillator, or in this case, call it a percent change oscillator, which in this case would be your RSI, your relative strength indicator. Similar thing. So here on a 5 day price change oscillator, you can see, I mean, this is wild on the percent change uh, on these prices. So the higher the price change percent wise, the more volatility there is. And you don't really want to trade those because those are higher risk. You want to get paid out for the higher risks. That's why when you look at things like gold and silver, silver is more volatile. That's why gold is preferred, because gold is more stable than silver. But there's other, as I said, other exogenous events, news, uh, things out external that we have no control, that is unpredictable, that can move against you. We don't have ways to get around that, unfortunately. It's hard to forecast that because we just don't know. And when you have the current president the way he is, highly erratic, that brings just more risk and more unpredictable volatility into the market. Some people say they can do really well in a highly volatile market. That's true, but it just depends upon your time frame that you're trading on as well. So if you're doing like a call parity, volatility is great because when that equilibrium's thrown off, then basically those are trading opportunities. But you have to be very quick on your trading through your automation. That's usually what is better known as high frequency trading. And if you're a market maker thrown on top of that, you can make a boatload using leverage as well. Again, that's another discussion. Here is more for passive, and not passive investing, but medium frequency type of investing. So let's look at some further stuff here. Okay, so now we're going to look at put options. So if we have a price decline, we have a new price, cash price, future price. We have an intrinsic value on the put. What's our net return going to be? Takeaway would be put option provides a floor price resulting in a profit of this. What happens if the price goes up? So the new cash price is this, along with the future. And again, you can see this is highly whacked out. That's kind of on purpose. This is not real world information. This is not investment advice, but just to demonstrate what this thing is capable of showcasing. So here we have no intrinsic value. We get a net return. The put option expires worth it, but the producer, the trader, whoever it is, benefits from the higher price. So this could be a trader, a farmer, let's say. Futures P&L over the last week. We have a buy price here, or sell price of that, profit times $1 per contract. This would be a profit result, as I said, profit. So here's where it gets very interesting. So if we have a put call option hedging strategy using our plot payoff diagrams, you can see here with our long position, put protection level here or here, and the strike price as well, right here. This is a really good plot to work from. Okay, and here's your protection there as well. Here and here, this is what like a kink, as they call it. And again, you'd learn that in the course that I've got as well. Ask away wherever you're watching this video. Okay, so we have an option price, but we can use our Greek analysis, the calculations. We have our underlying future price set at this amount of days to expire. Again, the risk free is whacked out, man. Okay, and our volatility again. Okay, so if we have a call option at the money, call option, if we have a strike price of this, price of that, plus the delta, and then we also have our out of money as well for strike, current price, delta. So again, we can measure out key takeaways. Again, delta measures option price expected to move given a $1 change in the underlying uh, asset price. So again, in this case, we go at the money, have deltas close to zero point 0.5 while the OTM have lower deltas. Again, more advanced terminology, I know, but take the course, you learn, and you live and breathe it over time and experience because I've only been at it a few months now. Okay, so again, options price, we've got our strike price and our expiry option price with the delta. And you can see those little deltas here. Depending upon you get better, we call them squiggles on the option, on the delta as well. So we have a option here. So again, if we have the option pricing, strike, here we can see those, what I call the delta with the amount, okay? And then the option price over time on the underlying price versus the option price as well. So we can visually see how the delta is working in there as well. So we're coming to the end here, close to it. So here we can visualize the dynamic of the commodity futures contract, the strike volatility and expiry, delta slope, along with the option price as well. And here's our deltas as well, the different simulated prices as well, option premium, and our underlying futures price with the hedge math again that we've already gone through. Um, so we have a put option with the assumed 5% drop in a futures price. Okay, put option on an assumed 5% underlying future price. Current price could be bushel, in this case, per unit, per bar, whatever you want, per gram, whatever. May futures price with a put price option, scenario one, strike price being this, premium price being that, with a floor price along with our second option scenario with strike price, premium, floor price. We do a comparison. So again, this is all using simple AI, and it will get more sophisticated as I mentioned. Option one offers a higher floor price but costs more. Okay, so we'll still choose between these two scenarios based upon correct, proper data. Okay, so again, considerations for an optimal strike price. Higher strike price provides greater price protection but incurs higher premium. Lower strike price is cheaper but offers less protection. So again, here we can have a put option strategy, assuming again the same thing with a 5% drop. Futures price scenario one, high strike price option at this, future price option at that, new cash price, intrinsic put option with a P&L, meaning expires worthless, but you could get a net return. Now, this does not mean it's correct, but just to give you an idea how this would work, key takeaway, the high strike price provides a strong price, limiting the loss during a price decline. Scenario two, low price, a low strike price option, a new cash price, a new futures price cash price, intrinsic value again, net return, uh, the price increase scenario. So this is the price increases, new futures price, new cash price, intrinsic value of the put. Okay, expires worthless, net return. So again, we summarize here with our key takeaway: lower premium price allows profit if the price rises, but offers significant less protection as the prices fall. So again, using all this stuff down the road as things get more intelligent, we're able to develop source code for this strategy on the fly. This is the early stages of the framework I'm talking about from this particular, in this case, gold, and the different scenarios to work from based upon what this thing's coming up with. So here we can compare different strategies, balancing the risk versus the reward. So here we have a high strike price at this, a low strike price at that. Here's our premium. What's our floor price going to be? What's our net return, meaning decline for both? Again, low price and strike price of both, or a net return. So again, we can role play here. This will look a lot more polished. So here are key points again. The suggestion is higher strike price provides better protection but costs more, while lower price allows for greater upside potential. Yeah, lower strike price, but you can read it. Okay, so what's the right strategy to choose? Tailoring your needs. So again, you can see where this is moving towards based upon forecasted data in the options, and it's coming up with what is the best strategy to come up with based around your needs. So if we have a price expectation being bullish, expecting price increase, we want a lower strike price. If it's bearish, we want to expect a price decrease, favoring higher strike price for stronger protection. And again, if you go back to the different option strategies, the bearish, the bullish, the neutral, so on and so forth, we can use those as part of this. Here, we're going to set what would the risk tolerance need to be. In most cases, a lot of people would be risk adverse for the trader. In this case, again, farmers may prioritize higher strike price even at a higher premium. The market outlook, meaning with the volatility, higher volatility generally makes options more expensive. So here, I think, let me just see how much more we got. So we're in the last one. So in this one, we have a put option call strategy simulation. Scenario one, where price declines on gold, commodity and bars, price decline. Okay. New future price at 25.20, new cash price at, dare I say, 984. Intrinsic put value be this with a net return. And the key takeaway in this case would be put option provides better price protection during the decline. Scenario two, if we have a price increase on the commodity of gold, goes up by this 70 cents. New futures price would be 25.21. New cash price. And again, I keep saying this on purpose. The difference between the cash and the futures, just under extreme potential, but it's not correct. It's purposely not correct. Just to give you an idea how this would work. The intrinsic value of the put would be this, meaning expiring worthless, net return being 21.28. Put option expires worthless, but the farmer benefits from the higher cash price. So here we can compare the scenarios. Okay, so we have a commodity strike price being at 30.50, premium at 153, initial cash price again, extreme, initial cash price at 17.53, initial future price at 25.20, and our basis, as we already said about the basis risk, gets really out of whack, and things to consider where our basis is this. So basically, what it boils down to is this. If you go over to my blog, or my forum, quantlabsnet.com, in there I've got my forum. If you go under here, and you're interested in this sort of thing, where I have call for elite traders. Okay, you want to be part of a group to beta test this, and you feel you meet these qualifications, by all means, open up a trading account profile on my forum. Let me know, and I'll let you know the next steps if you're serious about wanting to be part of this. Because it's pretty valuable, and it's also designed with AI in mind, and be able to dynamically, um, set source code via generation of AI, or generate code generation from AI, to be able to generate code from that under these conditions. The other thing is, if you're kind of overwhelmed by this, or you want to join my newsletter, want to get a free C++ HFT ebook, just fill this out. Your info won't be released, and you'll be able to get access to my free C++ ebook for high frequency trading, as you can tell. Thanks for watching. Have a good day.